In the grand scheme of things regarding the oil market, we note the continuance of the weakening of oil prices despite a correction higher over the past few days. Today, on the fundamental side, we take a look at the situation of the US oil market and then continue to examine the demand side as well as the supply side of oil. The report is to be concluded with a technical analysis of the WTI's daily chart. We make a start with the situation on the ground about the US oil market and begin by noting that the Baker Hughes active oil rig count dropped by 2, implying an easing of the demand side in the US oil market. Yet the market was taken by surprise on Tuesday as API reported a drawdown of minus 2,349 million barrels in US oil inventories, which was wider than the market's expectations and implied a relative tightening of the US oil market. Nevertheless, the tightness for the US oil market was also confirmed by EIA crude oil inventories figure on Wednesday, as it showed also a wider drawdown than expected, this time of minus 4,259 million barrels. Given that the US oil market seems to remain tight, as demand levels tended to surpass total oil production, it could provide some support for oil prices, especially if the relative tightness is evident in the readings of the coming week. We note that the market still has extensive worries about the demand side of the oil market, especially from China, as the red giant seems to be struggling to increase economic activity in the manufacturing sector. Yet tomorrow we note the release of China's industrial output and urban investment growth rates for November, and both rates are expected to show an acceleration. Should the rates accelerate, we may see expectations for increased oil demand from China rising that could provide some support for oil prices. Yet we also note the Fed's interest rate decision yesterday that showed that the bank is ready to proceed with extensive rate cuts in the coming year, which in turn implies an improvement of the financial environment and the prospect for increased economic activity in the US. The same applies also for market expectations regarding the BOE's and ECB's interest rate decisions later on, and such easing of monetary policy could support oil prices somewhat and vice versa. Also, the Fed's interest rate decision had as byproduct the weakening of the greenback, which in turn tends to support the largely dollar-denominated commodity. For the time being, there seems to be an oversupply of the oil market, yet investors are keeping a close eye on OPEC producers and want to see whether the production cuts, as announced by OPEC Plus, will be implemented. To that end, the market seems to expect the production data of the first quarter next year to be one of the most important. Overall, should there are indications for a possible lowering of production levels by Saudi Arabia, it may have a bullish effect on oil prices. Yet, there is still a wide uncertainty about the production side, as the intentions of Venezuela, Russia and Iran cannot be predicted with relative certainty. Especially, we still remain worried about Venezuela's intentions regarding annexing a large part of Guyana. A meeting is to take place between the leaders of the two countries. Yet should the meeting end fruitless, we may see tensions rising once again that may threaten directly the supply side of the international oil market and thus push oil prices higher. Also, the Israeli conflict is still ongoing, and there is extensive protest in Middle East countries about the latest developments, which could spark renewed worries for oil supply. WTI's price seems to be recovering as it broke the 70 resistance line, now turned to support. We tend to maintain a bearish outlook for the commodities price as long as the downward trend line guiding it since the 30th of November remains intact. Furthermore, we also note the downward slope of all moving averages on the chart, namely the 100, the 50 and the 20. Yet at this point, we should also note some signs of stabilization of the WTI's price action as the pair corrected higher and the RSI indicator has risen to the reading of 50, implying that the bearish effect on the market sentiment has faded away. Should the bears regain control over the commodities price, we may see it retreating below the support base of 70 and start aiming for the 66.85 support level. Should the bulls take over, we may see the commodities price breaching the pre-mentioned downward trend line in a first signal that the downward motion has been interrupted, break the 75 resistance line and aim for the 79.65 resistance nest. Thank you for joining us today as we navigated through the dynamic world of financial news. We wish you a solid trading from all of us at IronFX.